All right. All right, so welcome to the Austin Women's Investing Group Roundtable discussion, Q&A. If you've got your Qs, drop them in the chat box. If you have answers, drop them in the chat box, and we will kind of get going through the slides. Welcome. I think I already kind of went through this whole slide before, but for those of you who weren't able to join us and are watching this after the fact, this is the purpose of the Austin Women's Investing Group, is to get a bunch of women together and talk about investing in a fun and comfortable group setting. Welcome to all the beginners. I've had several conversations with people recently about whether they have enough experience to join the Austin Women's Investing Group. And so please tell everyone that yes, even if you have no experience, you have enough experience. This group is for everybody. So we need all types to be in the group. Chat box, we've already talked about that. Definitely use that to your advantage. This is just a slide about me. If you want to learn more about me, you can find me on LinkedIn. You can reach out to me, but I'll be kind of helping moderate the discussion for today. Here are the slides with all the disclaimers and disclosure information. None of this is intended to be individualized investing advice. Always do your own due diligence. Past performance is not indicative of future results. I don't think we have any charts today, but if I happen to pull up a chart later, just know that we're using data that's accurate to the best of our knowledge, all that good stuff. All right, Q&A time. So for those of you who just joined, we had some folks who submitted questions when they RSVP'd to the group. So we have those as part of the slides. So we'll go through those first. And then definitely as we get towards the end, or get through kind of the first batch of questions, hopefully we have time during our 2 hours to circle back and answer questions that are popping up in the chat box already. So kind of get those in the queue. All right, and I think we decided before the meeting that I think what we're gonna do is present the question. So we'll bring up the slide with the question. So I'll give you a couple minutes to look at this question. I've never invested in stock. What's the best way to start, like with baby steps, right? If you have experience with this, if you've experienced it before, and you have something, if you would like to answer this question, I think you can probably raise your hand somewhere in the chat box or drop a comment in the chat box, and we are going to loop you in so that you can tell the group what your experience has been with this question, because the answers aren't going to be just from me, they're going to be from everyone. So definitely jump in and let Gwen and Lori and myself know if you want to unmute yourself and jump in and answer the question. That's how we would do it if we were in the library. So this first question, this is one that always comes up in the group, right? Because we have a lot of people who are beginners, like real beginners, and are here to get started. So I am really curious to hear from the group first, how y'all would say that, this person, what is a good way to get started today investing specifically in the stock market, it sounds like.
Caitlin actually just typed something into the chat box, and she said that she called Vanguard and asked them what to do.
Awesome.
Which is awesome, because I think that might be exactly what the customer support representatives are there for.
Caitlin, do you want to unmute yourself and talk a little bit more about what that experience was like? And even like how you got to that point, like what was the actual question that you asked?
Well, I'm sure it was in your class that someone had, asked a similar question, or like, who do you invest with, whatever. And I had known about Charles Schwab, but it really very much felt like something that very rich men had a club pass to, and that had nothing to do with me. But someone had mentioned that Vanguard had no fees. I didn't even know fees were a thing, whatever. That somehow that was like the nonprofit version of a place where you could buy stocks, although I'm sure they make tons of money. But that, like, for someone like me, so I just called and said, look, I know I'm freelance. I know I've had an investment account before with one of the places I work for, but now I'm freelance. What can I even do? And they told me my 3 options. I think they also told me questions that I should ask, like I needed to know for my taxes or something like that, and just walked me through the steps. They didn't say what to invest in. But I think I already had in my mind, okay, by my age, there's a target retirement fund that they do. So I don't have to even think about, I'm going to buy this stock or that stock, but just like someone my age, they have a fund for that. And that's what I started with.
Awesome. So you just called and said,
they are so
I do.
helpful. It's like unlike any other customer support that I've ever experienced before. It's they must be so well educated, and just are used to people like me calling and be like, so what's the stock market?
Yeah.
And how can someone like me get into it? Yeah.
Awesome. I love Vanguard. I know we talk about Vanguard a lot in this group. I also really like Schwab. I feel like from my perspective, like Schwab and Vanguard's platform, like when you open an account online, their platforms are pretty user-friendly. There's also firms like TD Ameritrade, which is my custodian, and Fidelity, which a lot of people have access to through their 401k plans. They're also great companies where you can start this account, right? Because I think maybe to back up a little bit, if you've never invested in the stock market or in stocks or funds, you need to open an account first, because the account is where your stocks are going to live. It's like where the buying and selling happens. So kind of the first step is, okay, where is this account going to be? And so Caitlin talked about Vanguard, Schwab, Fidelity, TD Ameritrade. Those are kind of the big four. And then there's the apps, right? Which is where like I'm pretty quickly out of my depth with the apps, because I feel like I'm too old and I missed that part, right? Where like Robinhood or Acorns or whatever people are doing on their phone. Those are also companies where you can open an account, you put money in, and then you direct those companies into which stock or fund you want to buy. So the opening of the account is the first thing. And I will say, I know I've said this before, and I'll say it again, that this is not the last decision you're ever going to make, is where to open this account. So just pick one, and if you don't like it, you can move it to a different place somewhere down the road. So I think it's like not the place, hopefully, where you get stuck. I mean, Caitlin says Vanguard, like Schwab's fine, like they're all fine. They're all just going to open an account for you, keep track of some paperwork, and give you the ability to buy and sell investments. Does anyone want to venture out and say like, okay, let's say this person, she's opened an account somewhere now, because Caitlin kind of glossed over this part now, like what do you buy, right? Like there's the whole world of individual stocks, right? Apple, Microsoft, GameStop, whatever, right? Like whatever's out there. And then there are mutual funds and ETFs. Like if you were a beginner, I would be curious to hear like what some of you have some experience with this. Like where would you start? Like with your first $100 or $500 getting started?
I kind of like what Melissa said here. Melissa, I might have to ask you to unmute yourself and talk more about this, but she said, if not for Sarah, I would have never started to invest. I was saving a ton of money, but kept it in money market for over a decade, then started slow with 20% in a mutual fund in my 457 account, then eventually up to 85% mutual fund and 15% municipal bond. Oh, but she's on the mic today.
Oh.
It's just super interesting.
Melissa, how did you, if you don't mind dropping it in the chat and Gwen can read it or I can read it, how did you pick the mutual fund? And while she, if she's able to type it, she said she met with me to consult. So I must have pointed her in the direction that I thought that she should go. So maybe I'll use that opportunity to elaborate on mutual funds and kind of what you can be thinking about when you're taking this next step, right? Like you have this cash, how do you turn it into an investment, right?
I have an idea.
Yeah.
My sister doesn't invest, but she inherited some money from my father, and I was trying to figure out an easy way for her to do it. And I was thinking if she got a mutual fund that tracks the S&P 500. So basically, it's as if you're in the stock market because you're still getting that trend that goes up over a very long time, without actually having to care what the stocks are or what the stocks are doing every day. So if I was starting off, that might be one I would look at.
Oh, that's awesome, because it hits on kind of two different concepts, right? Like the first concept is the fund, right? Like the concept of a fund, a mutual fund or an exchange traded fund, which is an ETF. And the way that I like to think about funds is that it's like a basket, right? It's a basket, and in the basket, like in the case, with what Lori said, there are 500 companies, the 500 companies that are listed on the S&P 500. They put stocks of the 500 companies in this basket, and then you just buy a piece of the basket, right? And the price of the basket goes up and down with the stock market. It just tracks the stock market up and down. But like if one of those companies is Enron, it's okay, right? Because you have 499 other companies that are in there offsetting the failure of one company. So it makes it relatively easy because most of us, certainly like when we're talking about the stock market, one of the ways we talk about the stock market is what has the S&P 500 done today or this week or this year. So like Lori said, you are in the market, but you don't have to pick just one stock, right? And you don't have to really know, you don't even have to know what those 500 companies are if you don't want to. You just have to know that they are 500 companies and they're based in the US and they're mostly pretty big and you've heard of most of them, but you just buy a little piece of that basket. And that can actually be like relatively easy at Vanguard or Schwab or Fidelity, because all of those big custodians have that S&P 500 index fund option available to you to buy.
And something else that I find interesting is that if you're looking at funds and you're comparing things, they will often compare it to the S&P 500. So you could do the first step of just getting an S&P 500 fund, or it helps you if you know what it is. So now when you're looking and comparing the funds, you can see how it would compare to that. So you can imagine if I had this mutual fund, which was the S&P 500, or this other one, which they might call growth, you can see how they, like what percentage increase or decrease they have over years. And so I usually look at that when I'm trying to decide between them. Yeah. I look at the past year. So for example, this past year, even though the economy's been weird, stocks haven't really been going down. So I look and see if the fund earnings for the past year kind of match what I think the market in general has done. Mm-hmm. And looking at the S&P 500 will help you determine that too. And then I look at 5 years, but I sometimes just ignore that and look and see what does it do over a big period of time, because usually it'll show you 1 year of performance, 5 years performance, 10 years, and then since inception, which will be different for different funds. Some of them have been around a really long time. And so if there's a number there, you know it's been around longer than 10 years, which is also the sign of a good fund if it's been around for a while. And if it's blank, that means they don't have any information. It hasn't been around for very long. Well, for, you know, whichever one is blank, it means they don't have any data for that, the 1 year, the 5 year, or the 10 year. And also, if I was starting off, I would not get one that doesn't have any 5 year information. Yeah. Because if I'm starting off and I don't know what I'm doing, I wouldn't buy one that might be considered risky. It hasn't been around long enough. From that standpoint, you would only get those kind of funds if you really know what you're doing and you read a lot of papers and you evaluate funds for a living. Yeah. Like Sarah.
Yeah. Yeah. I mean, but I always love the idea of starting with the S&P 500. because I like it because it's a diversified stock fund. You're still in stocks, right? But it's 500 stocks. I also like it for beginners because if you are trying to get up to speed, watching the way your S&P 500 stock fund moves will give you an idea of what I think of as like the rhythms of the market, right? If you're in the stock market, you need to get ready for the ups and downs, right? Because there's ups, but stock market doesn't only go up, it goes down too. And so while you're watching it go up and down, you'll start just getting a feel for what it's like to invest. You know, like what do you do when the market goes down? That to me, like, is one of the most important things you need to ask yourself, right? Is if I invest $500 in the S&P 500 and it falls by 20%, and now my $500 is worth $400, what do you do, right? Because I think that if you're investing for the long term, hopefully the answer is like, well, nothing. You just kind of wait for the stock market to work itself out, those 500 companies to, recover and start growing again. But you really need to know for yourself if that's true or not, right? If your S&P 500 fund falls by 20% and you feel really bad and you feel like you need to jump out, you need to know that about yourself probably sooner rather than later so that you can figure out what investment strategy works for you. So I think there's a lot of different really good reasons to start with an S&P 500 fund and not to start with something more specific, like trying to pick a stock. Does anyone else have any kind of input on like best baby ways to start? I think we talked about opening the fund. We talked a little bit about what you can actually buy. You have to open the account, then you have to put money into the account, and then you log into, let's say, Vanguard, and you direct Vanguard on what to buy. And the way you actually do that is by using something called the ticker symbol. So at Vanguard, the ticker symbol for the S&P 500 ETF is VOO. There's a different ticker symbol for the mutual fund version of it, but you have to know that piece too. And that could be where you get tripped up. But that's when you call customer service, like Caitlin said. They're there to help you. If you just say like, hey, how do I buy an S&P 500 index fund? Customer service can help you get there.
So I'm a huge fan of Vanguard as well. I'm also read it a lot with the FIRE movement, or more importantly, the FI, which is financially independent. So of course, I'm like the book girl, but this is one of my favorite books. It's The Simple Path to Wealth. It's literally a blogger. His name is J.L. Collins, otherwise known as, I would have to look at his website here, but he also, there's a ton of bloggers out there, but his basic thing is VTSAX. So you pick he breaks it down and says the simple path to wealth is thinking 2, maybe 3, and just ride that, right? So you just it's not day trading at all. So BTSAX, which is US based, and then you can also do bonds, and then Vanguard bond stock market of the bond index, and then if you wanted to, you could also throw in international to make it a 3-legged. But I love that, and I started what was it, a couple of years ago? I started doing a taxable brokerage account with Vanguard. So I have, 401k with work, and I have IRAs from previous work that I've rolled over. But I opened up Vanguard and started to put money into just a regular brokerage account. And I'm just doing, I do dollar cost averaging, $25 every 2 weeks goes into the account, and I have it automatically set to invest into these two. Well, actually, I think I've only bought VTSAX in that brokerage account. But I also set up an account for my son, the UTMA, and I also do the same thing. So $25 goes into his account. And so we're going to see. It's like, the strategy is put it there and don't touch it for 10 years. Just keep doing it.
Yeah, that time component is so important. And VTSAX, the fund that Sandy mentioned, is the Vanguard Total Stock Market Index Fund. So it's the S&P 500 on steroids. It's not just 500 companies, it's 3,500 companies that are all based in the US. So you get even more than the 500 companies in that fund. And the ETF ticker is VTI. I saw Ruth said, if you really want to buy a stock, like an individual stock, start with something you know and research it. Ruth, do you want to elaborate that on a little bit? Are you in a place where you can unmute?
Sure. I just think it doesn't have to be overly complicated. I'm teaching the class that you're sponsoring at the high schools. I think that's so great. Yeah. Thank you so much for doing that.
No, thank you.
Yeah, it's so super fun. I'm having the best time. But you know, I have these 4 amazing girls. They're so super smart, and I want them to just join us. I'm like, oh, I want you all to do this. But you know, I tell them, you know, what shoes are you wearing? What's your phone? What computer are you on right now? And you know, what's the name of your shirt? You know, what makeup did you use? And just research all of that. You know, we all got an Apple phone. You know, we all got this kind of computer, and just, you know, start there. If you really want to own a stock, not a mutual fund, an ETF, or any of that stuff. And it doesn't have to be overcomplicated. I mean, yesterday the girl was asking me, well, I want to do something in agriculture. And I said, I mean, these are high school girls, and I'm helping with the stock club. And she was like, I want to do something in agriculture. And I said, well, what do you mean? That's so broad, right? You know, and we had to funnel it down, and we finally got to, you know, Beyond Meat. And, you know, she wants to do something like that. So, you know, just you start broad, you go down, but just, you know, every day, what do you get up and do every day? So just, you know, think about it that way. Don't be scared, you know, I would tell them. Yeah. So.
Oh, I love that so much. I mean, even backing up a little bit more about like, what is a stock, right? Stock is ownership in a company. When companies get larger, they get more valuable. Those things go hand in hand. And so how does a company get bigger? It gets more customers, right? And so that's a very important component of what Ruth said, right? Like, where are you spending your money? Like, there's a really good chance you are spending your money on a company that is then poised to get bigger because it's getting more and more customers like you. You know, on the flip side, what types of companies or what companies are you abandoning? What companies have you not thought of in 10 years or 1 year, right? That can show you the types of companies to maybe stay away from. So those are definitely ways where you can think about your own life, where you vote with your dollars, if you want to go down this road, which is much more difficult, right, of picking an individual stock, but can be really rewarding and really fun. And again, like a way of like figuring out how the market works, because you certainly learn from making good investments, and you probably learn twice as much from making bad ones, right? You don't want to make sure you don't, you know, make like too many catastrophic bad calls. But maybe another thing when you're starting out, like Ruth said, like, don't be afraid, and maybe don't be afraid of failing, because you're not every idea you have, or not every investment is going to be timed right, or is going to be the right investment. But the fastest way to learn is by doing it. I think that's something like this group I hear over and over again from people is like, oh, I didn't do it, and then I started doing it, and now I know way more than I did before I started, right? That's how we do it. So I love that. I love that. Cool. Sorry, go ahead.
Oh, yeah, I also, like Ruth, have been trying to think about the things that I buy, and I've done this fun activity within a 2-week span of actually like writing down every product that I use, and then actually looking each day what product I use and what their stock is doing, just as a fun little activity. And I've been trying to do like everything from like toilet paper, because I just think it's really fascinating. And the other aspect that I've been trying to work on in terms of starting is trying to start at a time when I'm really optimistic, because I also have like almost like paralyzed by decisions. And I find that like if I'm optimistic about the future, I feel much more comfortable like learning something new, or I feel much more comfortable trying to make a decision of like what to buy, or actually just start the buying process, and then just feel a little bit more optimistic, like this stuff could work out in life. And I think there's maybe some more research to be done about like how we can put ourselves in that mindset, almost like having a piece of chocolate before you have to log on, or like doing silly tricks that'll help you just feel excited.
Yeah.
We're doing this.
I love that. Like the mindset of abundance, or like the money mindset, or the growth mindset. I mean, and like for me, I think like as someone who maybe grew up as somewhat of a perfectionist and has learned how to let that go, like it's like not being afraid of failure, right? Again, like you can turn, especially in the stock market, you can turn your failures into teachable moments. It's so easy to turn them into teachable moments. I mean, how many times do you have to lose money on a stock that your brother-in-law recommended to you, right? Like you make that mistake once, right? Or like whatever the version of that is, maybe doing something impulsively, or not doing research, or FOMO, or like whatever it is. Like you will learn from those just as much as you'll learn from, oh, hey, like I bought the dip, or I saw this trend before other people did because I was buying this product before it really blew up, right? Like, and so those are really, really, I don't know, fun lessons to learn. They can be fun. So thank you for sharing that. I'm going to move on to the next slide, and we'll get started on the next question. This is certainly something that we can come back to, or that you can drop comments in the chat box as we continue on, as things pop up. So thank you for whoever submitted that first question. Awesome. And thank you for everyone who commented. Let's keep going and see what the next one is. I'm on the edge of my seat. Let me move one of my boxes out of the way so I can see what's going on here. Ooh, all right. So let's pivot to approaching retirement. What are your best ideas on the best way to invest for the last 10 years before retirement? So before, and I'm gonna kind of think of the word retirement as 10 years before you start drawing money out of the account, unless the person who asked wants to, not have me clarify it like that. I think of kind of this word retirement as, okay, that's when you start drawing money out of the accounts. So what things should you be thinking about if you're 10 years out from using these investments to live off of in retirement? That is a great question. Does anyone have, is anyone going through this right now, or have comments or questions or concerns about this? This is a great question. I would love to hear what you guys have to say. Ruth says dividends. Go ahead.
This was my question.
Oh, yeah.
And I'm 57, so really, I'm supposed to be able to retire at 67. I'm not really anticipating that, but I want to make that best last push before. And so I don't, because RMDs don't start until 72 now. Yeah. So I'm looking and hoping that I won't have to worry about anything until I get to that RMD part. Yeah. I anticipate that I would still work part-time, and they make me take retirement, or I don't know, have a part-time job or whatever, wherever things would go, that I wouldn't have to. So I'm just looking right now for that last good pushing for best investments.
Yeah. I mean, so thank you for clarifying, because I think that really changes the way that I think about your question. And so because you said the word push, right? Yes. So it sounds like you are still looking for growth in order to get ready for this period of time that might be 10 years from now, but you're hoping is 15 years from now. Yes. When you start taking money out of the account. And there was, Sandy answered the question. There was a question about what RMDs means.
Oh, sorry.
Yeah, so it stands for required minimum distributions, right? Yes. So Melanie, do you want to talk a little bit more about the RMDs just really quickly?
Me?
Yeah.
Oh, I only know because my mother hit that at 70 and a half, and she was still working as a substitute teacher, and she had her teacher benefits from when she was a full-time teacher, and my dad's investments and Social Security. And so she was like, I don't need to take that money out, but why? You're going to tax me on it. And that was the whole thing, because they were at IRAs and investments. And so they made her take it out so the government can collect the taxes on it. And if you don't take it out, then they go ahead and take the money anyways. So she had good investors who then called her every year and said, it's time to hit those accounts and take this so much out, because she didn't take any out during the year. So she'd take it out and throw it into a CD and then use it as she needed it. Or probably some of them are still sitting in CDs.
Yeah. Yeah, you're exactly right. So this idea of required minimum distributions, the concept is really important now as you approach age 72, right? They just changed this with the Secure Act. It used to be 7.5, like Melanie said, but for Melanie, it's going to be 72. Who knows? It might get increased again before you actually reach that age, but as of now, it's 72. So that means that any money you put aside in a 401k or an IRA, something that has not been taxed yet, they make you start taking it out at 72, like Melanie said, because you have not paid taxes on it yet, and they're not going to let you defer the taxes on it forever because, that we need money. So the IRS tells you how much money you have to take out. So it's required, you have to take it out. It's a minimum amount that's decided by the IRS, and you calculate it by taking the balance of your accounts and multiplying it by a number based on your life expectancy. And you do that every year. So it's a knowable amount, and you can make projections on how much they'll be over what time period. But it's important that you take them out, because there's a 50% penalty on RMDs that you don't take in a timely manner, and that's a stiff penalty. So it sounds like, Melanie, it's like, okay, well, if you had 10 to 15 years where you're not ready but again, I'm coming back to what Melanie specifically said when she says push, right? Like, what could you focus on if you still want to be growing your money? You're not ready to take money out right this very second. You still have time to grow it. What would you say, Melanie, like if you had to, like, your risk tolerance, like on a scale of 1 to 10, like 1 being, not ever wanting to lose a penny over any period of time, to 10, like you're just like out there, you don't mind being in the stock market going up and down. Like, if you had to put it on a scale of 1 to 10, what would you say you were?
Invested with Edward Jones. And so I go through this once a year with them, and we have to do this survey. Yeah. And I'm about a good 8.
Okay.
Because I feel like I still have time to recoup. And also I've been rolling I know where the tax breaks are, and then I roll some money from my IRAs into my Roths every year, so they can help pay off some of the tax now, since we have some of the lowest tax rates, and then not have to be faced with it later. So yeah, I'm a good solid 8.
Yeah. And
that's why I want to invest more, because I feel, I'm at the point now where a bunch of things are paid off. I don't have any debt, and I want to invest now and make the most of the cash that I'm bringing in now.
Yeah, cool. There are some cool suggestions in the chat box that I'm going to bring up and maybe have some people elaborate on. So Ruth had 2 comments. She said dividends, which I'm assuming means like a focus on dividend paying stocks. And then she also talked about either maxing out your Roth or converting to a Roth. Ruth, do you want to jump in and talk a little bit about dividend payers and why you think that would be a good direction to go?
I just think those stocks, they're not a lot of growth sometimes, but they're a real good way to preserve your investments. And, I think you want stability in those last years, but you do want a little bit of growth. And so I think they're the best of both in that sense. But I think she's already doing a fantastic job. I mean, she already was on top of it. She's like, I got my Roth, I'm converting. I'm like, man, you're already doing great.
Yay! Yeah, I kind of think that too. I'm like, if you're still an 8 and you're working with your advisor to make these tactical moves, then I think you're like on the right track, right? Like, it's certainly, typically as people get closer and closer to the time when they need the money, And ideally, that is also dovetailing with you're getting closer and closer to the time you need the money, and your accounts are getting larger and larger, right? That at some point, you know, you kind of hit this. It's like the nest egg. It's like the number that you're targeting, right? Like I want my accounts to be at $1 million or $500,000 or whatever the number is that hopefully you've calculated with your advisor, right? And then as you get closer and closer to that number, I mean, then it's like, oh, we put a plan together. We worked the plan. We achieved the goal of the plan. Now maybe you have the option to get less aggressive as you go into, you know, your mid 60s or your early 70s. Yes. But you don't always have to be an 8, right?
Yes. Because
it absolutely is easier to be an 8 at 57 than to be an 8 at 67, right? And so, like, I mean, I like everything that you said. I think I mean, you know, without knowing the specifics, I think that's also, I think that it's awesome. Is there anything that's like concerning to you about what your strategy is so far, where you think you're missing something, or like, are you looking for maybe like to fill a hole that you feel like you might have in your plan?
I'm not. I was just looking here at some of the comments about the leveraging the catch-up contributions. I had done those before, but I've been laying low kind of work-wise for a couple of years, and so now I'm back blazing guns. So yeah. I think yes, adding more to my Roth and totally, you know, I'm maxing out the Roth IRA. And hitting all of my, I know I've talked to my advisor about that too, about making sure I, you know, put in everything I can being at this age. Yeah. And then it's for sure, you know, the lower tax rates in that Roth. And yes, that was, I guess, probably, I just wanted some clarification that maybe I am on the right track and trying to get it all done in a timely fashion.
Yeah. One other little, like a little trick maybe that that I can pass along is when I'm thinking about, you know, all of your accounts, right? You've got a Roth account, which you've already talked about. You must have a traditional account somewhere, right, in there, maybe a brokerage account in between. So the Roth account, and for everybody on the call, you know, we haven't talked too much about accounts yet, a Roth IRA or a Roth 401k. The idea is you earn money today, you pay taxes on your earnings today, and you put the rest of it into a Roth IRA or a Roth 401k. You invest the money, it grows and grows and grows, and then all of that comes out tax-free when you withdraw it. So for me, like in your position, like focusing all the high growth stuff, or as much of the high growth stuff in the Roth IRA, and supercharging the Roth, because first of all, you don't have to take RMDs from a Roth. I think someone pointed that out in the chat. So you get to age 72, you can just let that baby keep going and keep growing, right?
Oh, okay.
So having the Roth IRA focused on growth, maybe you use it at age 72, maybe you don't use it till your 80s, maybe you never use it. I don't know. It depends on how this all works out, right? But that piece you can have most of your growth assets in there, because all of that growth is going to come out tax-free when you take it out. And then putting your more conservative investments, especially bonds, in your traditional IRA, because so with the traditional IRA, just to back up for everyone, you earn money, you put those contributions in before paying taxes, you invest the money, it grows and grows and grows, and then when the money comes out in retirement, you owe taxes on it, right? And it's taxed like a deferred paycheck, so it's taxed at your ordinary income tax rate. So is interest on bonds. So you can match up like your interest paying, more conservative investments, plug those into the traditional IRA, have your growth assets in the Roth IRA, and then you're kind of matching up which account works best for which asset. Does that make sense?
It makes sense, yeah.
Instead of having every account be perfectly diversified, your portfolio is diversified, your stocks are in your Roth, your bonds are in your traditional, with probably some stocks in there too. Your brokerage account has stocks and maybe some muni bonds in it, some municipal bonds because they're tax-free. But now you're starting to take advantage of asset location, right? Where do these assets grow and what's the taxation of those accounts? Eventually that might end up being, maybe something that you can take a close look at if the portfolio is not already set up like that.
I can change it out. So I will speak with my advisor and see what we can do. Thank you so much.
Yeah, cool. Great question.
Sarah, well, along those same lines, do you have recommendations for the split between percentage-wise of what you should put in an IRA versus a Roth? I know it's so personal, but it's, and it's like, where's your crystal ball so that you can predict the future, to know. But I can tell you that something that changed my mind a little bit is the Secure Act that took away the stretch IRA. Mm-hmm. Because I was planning to leave, an IRA to my kiddo, right? If there's money left. But now without now he's going to be forced, if he inherits my IRA, he is I think it's 10 years to basically drain the account. So that made me think maybe I should shift more to the Roth, but I don't know if I'll be in a higher or lower tax bracket in the future. So I don't know if you have any thoughts about splits.
Yeah, I mean, so that's a really great question. And this is certainly not a recommendation, right? It's just kind of like a thought process that I'll throw out there. I find it easier to make decisions based on what we know, right? Like kind of what we know now and starting there, right? So with the question on a Roth or traditional, I start with what tax bracket are you in now, right? Because that can lead you down the right path. We're down to like a fine path, right? And so like the calculation is, if you're in a relatively low tax bracket, just pay the tax at the low tax bracket, put in the contributions, let it grow tax-free for a long time in growth assets, and take it all out tax-free in the future. Or pass that, if you pass that IRA down, like in the case of your son, he still has 10 years. He has to take the Roth IRA out in 10 years too. It just comes out tax-free. If you're in a relatively high tax bracket, or in years where you are in a relatively high tax bracket, right? You had a good year, you got a big bonus, you like whatever, like you're in just a high tax bracket, then avoid paying taxes at the 33 or 39% rate. Don't pay taxes on that today. Put the money in a traditional account and deal with those taxes later, right? Those are called tax deferred accounts. It's just like kicking the can down the road, right? Like we will deal with this later. I mean, realistically, like if we go back to Melanie, like as you roll into retirement or the retirement planning years, that's when I think you really take a hard look as to like, where are my accounts and what changes can I make to get ready for the next era of my life, right? Like as you're getting ready for retirement, you can start thinking about, well, first of all, you will know what the tax brackets might be at that stage in life. So something that is unknown now will be known then. And then there are opportunities to do conversions where you take money out of a traditional account, you pay tax on it at whatever tax bracket you're in at that point, and you convert it to a Roth. That's awesome during years where you're working part-time and you're getting it into that Roth IRA. And like in your case, you are absorbing the taxes and you are sheltering them from your kid. If that's important to you, then you can use those years to do that sort of thing. And so there's a lot of strategies that you can implement down the road. So kind of going back to your question, like with, okay, well, what do you do now? I almost always start with what tax bracket are you in now? And based on your career, your expectations about the future, is there some opportunity to pay taxes at a lower rate in the future? In which case you want to avoid paying taxes at high rate today and then just pay them later when you're in a lower tax bracket. So I kind of danced around that without like really giving an answer, but that's how I think about it.
No, I think you,
yeah, go ahead.
No, I think you gave me a different perspective because most people don't want to answer it. And it's more about how to think about answering it rather than giving an actual answer. And I think that's super important. So you said something that I wasn't really, I don't think I was completely aware of, and that was that the Roth IRA is still, you have to withdraw that within 10 years as well. It's not, I thought it was protected.
No, it's not. All IRAs now for people, unless your beneficiary falls into a special category, is a spouse, is like a minor child or disabled relative or beneficiary. There are some exceptions, but the parent to child inheritance is not a special category. That's like all IRAs will now need to be distributed within 10 years.
Does that apply with even if a minor inherits just a regular IRA now, or does it mean that when you're age 18, the 10-year clock starts ticking?
Oh, that's a really good question. Do we have someone on here? I can't remember. And the minor child isn't required. The minor child is a designated benefit or a designated person.
The language, from what I remember, said something like when they are an adult, but I didn't see anything that said, does that mean 18? Does that mean 21? It's like, What does that mean?
Yeah.
Probably whatever
you're dig around to find that out.
I'm just kind of curious. Yeah. And then, one of the things that that the next other hot thing too, and even thinking about, I don't know how much money Melanie has in an IRA or a Roth, but I don't know how often, Sarah, you deal with conversions and doing that backdoor and doing some sort of mega ladder program, where you are able to start shifting, because that's also something I was considering, but it doesn't make sense unless you're maxing out your accounts, right? So because right now with my employer, I can put money directly into a 401k Roth account, so I really don't need a backdoor. But if I wanted to contribute more, or somewhere down the line, I was just curious if you do that kind of strategy at all.
Yeah, I mean, absolutely. Towards the end of the year, maybe this is something we can circle back around with on the end of the year, this idea of conversions. Did I already explain a conversion? It's when it's a specific term. It's when you take money out of a traditional account, you pay taxes on the amount that you withdraw, and then you move it over into a Roth account, a Roth IRA. So it's called a Roth conversion. And you usually do it to pay taxes at some relatively low rate and move it over into your Roth to grow. It's all based on income, right? So now is a really good time. You're filing your tax return. Look at your tax return. Look at what the boxes are for, right? It's like box 1, W-2 and wage income, box 2, Social Security income, box 3, and one of those boxes is distributions from an IRA. It just goes on the front. It's part of taxable income, right? So it becomes like a game or a calculation. It's not a game, it's calculation, right? Okay, how much can we convert and still stay in that low tax bracket? If you converted $1 million, you would be in the $1 million tax bracket because that $1 million gets put in with your taxable income. But if you have, let's say you have $10,000 left in the 22% tax bracket, did I say 10,000? Maybe you convert 10,000 at 22% because that's a relatively low rate. You move it over to your Roth and you let it grow. And like that's at least something to be thinking about at the end of each year. But it's usually once you know or have a really good idea what your income is going to be like, and most people don't know that until the end of the year, right? Like, oh, I got these bonuses, this is how much I worked, this is how much in capital gains my investments are spitting off, right? This is how much I got in rent. But now is the time to familiarize yourself with those boxes on the tax return, and then you can do the just addition, the work of adding it up at the end of the year to see if there's room to do something like a conversion. Really good questions. And that's definitely, like Melanie, like you'll eventually, I think, get there too if you're not working on that already. It's like, okay, is there an opportunity, or can we look forward to a time when you're working part-time and you have lower W-2 income? Now you have more space in the IRA distribution box to do some conversions. So typically those things make the most sense when you don't have a full-time job, right? Either you get laid off, or you take a sabbatical, or you are partly retired or fully retired, but before you take your required minimum distributions. So that was a lot, but really, really good questions. A lot of things to think about. I know we kind of probably brought up some things that we can circle back around on the Q&A too. But I think we will move on kind of to the next. Oh, hold on. There is one question that Melissa just popped in that I'm going to tack on here. She asked, can you do a conversion up until April 15th, tax day, or do you have to do it by 12/31 as far as calculating taxes? That's an excellent question, Melissa. It's a calendar year, so you have to have it done by December 31st. So if you wanted to do a conversion in 2020, time's up. Even, you don't get to do a conversion after December 31st. You can still make a contribution to your IRAs until the tax filing deadline, which for us, is June 15th in Texas. Sorry, and I know not everyone on the call is from Texas. In Texas, it's June 15th because of the winter storms. Everyone else is May 15th. It's usually April 15th, but the conversion is on a calendar year. And contributions to your 401ks are also on a calendar year. Cool, all right, let's keep going. Oh, you guys, this is so awesome. Thank you for sharing on that one. Really good question. All right, what is next? Sorry, I have 100 boxes open and they're all over. Here we go. Okay, ooh, self-employed people. Yes, all right. Self-employed. If I max out my Roth IRA, which is better to fund? SEP IRA, cash portfolio, I'm assuming that's like a regular taxable brokerage account, or something else. Do we have any self-employed people out there who want to weigh in on the order? It sounds like the order in which you fund your accounts. Or if the person who submitted this question is on the call, if you want to elaborate at all to make the responses more useful, please just chime in.
Hi, good afternoon.
Hi.
I am not self-employed. I'm a wannabe self-employed, but SEP is the self-employed pension something. I believe they used to have a 52K or so per year cap, as opposed to the rest of us common people on earth. We have 19,000, but I believe it's more like 52 to 55. The numbers changed. And it gives them a whole lot more flexibility, I believe, but also obviously it comes with a cost. You have to pay the Social Security and the Medicare out of your income too, as opposed to an employer paying for it.
Yeah, I mean, the saving as a self-employed person is, there can actually be like a lot of benefits, right? Like Rakshanda mentioned, like you have higher limits with a SEP IRA. But while there's like, I think it might be 56 this year, it's something like that, you check the IRS, it's actually based on a percentage of your self-employment income. So I love that you maxed out your Roth first, right? So that's great. Your next options as a self-employed person, certainly the SEP IRA. The idea would be your CPA would calculate your self-employment income and multiply that by 20 or 25%. I can never remember, it's a question for your tax person, and say, okay, if you made an additional $10,000 contribution to your SEP IRA, it would lower your taxes by this much because a SEP IRA is a pre-tax account. I think maybe I'm going to kind of continue down the self-employed people's option for a minute. You have the SEP IRA, which is really intended for people who are self-employed and don't have employees, right? So I am self-employed, but I have employees. So a SEP IRA is not going to work for me. I use something called a simple IRA. It's actually for small businesses, right? But a self-employed person would qualify, where those limits are $12,500 per year. And there's a catch-up provision if you're over the age of 50. And there's a matching option for a simple IRA. So that could be another option. Again, it's a pre-tax contribution. On continuing down the options available for a self-employed person, there's also something called a solo 401k. Again, this is only for someone who does not have employees. You do not want to open a 401k plan and have eligible employees, or it becomes a total cluster. So don't do that. But if it's just you, you could open a solo 401k, and a solo 401k has the same contribution limits as a regular 401k, which is $19,500 for employees. Plus you can match yourself because you're the employee and the employer if you are self-employed and it's just you. Vanguard, I know, has a really good self-employed retirement section where all of these different rules are laid out. So but all of these are pre-tax contributions, right? But depending on how much income you have available to set aside into a retirement account, one of those three might work best for you. And I'll kind of explain that for a second. You know, if you are self-employed and you're married and your spouse, you can live off your spouse's income, and you could theoretically set aside all of your self-employment income, 100% of it, then the 401k might work better for you because it has higher contribution limits unless you're making like $250,000 a year. If you're making $250,000 a year and you can max out the SEP IRA at $56,000 or $57,000, that might be the better option, right? So like that question about which account is better gets really, like, the devil is in the details, right? So that's like, if you want to set that money aside for retirement, you get the tax break today, right? You're putting it into a tax deferred account, you're punting on taxes, pushing those down the road, and then you'll pay taxes when money comes out of a SEP or a simple or a solo 401k. The cash portfolio part is interesting, right? So again, like, please correct me if I'm wrong if you're on the call. I'm taking that to mean like a regular taxable brokerage account, where it's just an account in your name. Like, I open an account, Sarah Glakis, individual account. I can put as much money in there as I want. I can invest in whatever I want, but it's not, I don't get any tax breaks, right? If anything, you know, the dividends that I receive on stocks, I pay tax on the dividends. If I sell anything, I pay tax on the difference between what I bought it for and what I sold it for, assuming that I make a profit. But there are no limits to it, right? So for retirement accounts, and this is just kind of in general, like, retirement accounts are intended to, the money's intended to stay in there until you're 59 and a half. And there can, you know, there's strings attached to it. If you need to take withdrawals before 59 and a half, you could be hit with taxes and penalties. So the difference between like the retirement accounts and the brokerage account is often a function of like, okay, well, when do you need the money? If you know you don't need it until retirement, then it's almost always better to just put it in a retirement account, and you get the tax benefits from doing that in some way. Either you avoid taxes in the future or you avoid taxes now. If you're thinking like, well, okay, if like I'm 41, got a long way to 59 and a half, I definitely want to invest that money for the long run, but what if I want to use it in 10 years? Well, then I don't want it in a retirement account because I'm gonna have to pay a penalty to get it back out. So if that's the case, then maybe it does go into a brokerage account. You can put as much money into a brokerage account as you want and invest it any way you want. You just know that you have to pay taxes when you sell something, or when you receive dividends, or when you receive interest. But that can all be managed. So that's my initial thought. Like, is there anyone else who in the chat is kind of thinking through the same stuff? Like, what additional thoughts do we have on that? So we've got people who have SEPs and have solo 401ks. Yeah, so Caitlin said before that she was at Vanguard, right? Like, again, like they have, a Vanguard rep would be the perfect person to walk you through the difference and which plan might be best for you. in conjunction with your CPA would be, or a tax prep person would also be a good person to loop in. Sorry, now I'm gonna read through the chats. Okay. All right, so maybe that is, are there any other thoughts or options or strategies that anyone wants to throw out on this one, the self-employment one? Ruth? No?
Well, I've recently opened my SEP a few years ago, and that number of 58,000 seems like really enticing. That'd be great to have 58,000 in your retirement every year, but it's based on your income. So, you know, as a self-employed person, you have a lot of deductions. So you go through, like, you know, say you have $100,000 of income, and then you take all your deductions for whatever your business is. So then you might only get down to 50,000 to begin with, you know?
Yeah.
And so, I mean, I think it's more difficult than we realize for self-employed people to actually obtain that number.
Yeah.
It seems really enticing, like, oh my God, I'm going to quit my job and go self-employed. I think it's more difficult than people realize, and that's why they've set that number at that threshold. Has been my personal experience, and I'm just speaking from my personal experience. I do the SEP, the Roth, the HSA. I've done an IRA in the past. I roll over my HSA every year and just keep that growing. But I mean, I think it's difficult to reach that 58,000. So I would challenge people that, I have a lot of people that are doing side hustles now, and they're talking to me about it. And I'm like, yeah, go to the IRS, get your number and start it. I think it's a great option. But just obtaining that threshold can be challenging.
Yes, excellent, excellent point. Because it's based on a percentage, it's either 20 or 25% of your net self-employment income, right? So like Ruth said, like it's what's left over after accounting for everything else that your business paid for, right? That's what the number is. So it might work well for a solo Austin real estate professional who makes $1 million and made $1 million, or is going to make $1 million this year and has no employees, right? Or has not, it's actually like you can't have employees in 3 of the last 5 calendar years. There's a 3 of 5 rule. But there are a lot of strings attached to that SEP. I mean, Ruth, like to your point, like being able to make enough in self-employment income, net self-employment income, to have 25% of it be $58,000 is a lot, right? We're talking about like several $100,000 net on your self-employment business, which again, like this is why you would loop in your CPA and you would look at the Vanguard or the Schwab page or whatever and see which one works best for you. I kind of like to think about when I'm thinking about retirement planning, or I tell people like, okay, figure out how much you can save first and then figure out a home for it. Right? Like if you can save $50,000, great. Like, okay, like based on whatever your income is, you're going to have access to different types of retirement accounts. Let's max those out as best we can. But if you end up not being able to find a home, or an HSA too, if you end up not finding a home for all $50,000 in something that's tax advantaged, then just chuck the rest of it into a brokerage account and pretend like it's for retirement, even though the account doesn't say the word retirement in it. So the savings piece is definitely the most important piece. And all of these different plans have different strings attached to them, and you can find the whole list of rules at the IRS website, which is actually like pretty easy to navigate and written in pretty good plain English, right? So it's a really good resource to figure out what might work best for you. And what might work best might change from year to year or change based on your circumstances. So having some idea of what the self-employment retirement plan rules are is going to be helpful. Cool, great one. All right, let's keep going.
I do have a question. Is it okay to ask a question on the previous slide? for the salute to you and Ruth and all the others. If it was easy, everybody will be doing it. So trust me, we're finding that out. I have self-employed people, but anyway, not to digress. And Sarah, kudos to you. Did you just give me an idea to be $1 million real estate investor or agent in Austin as my future job?
Yep. Yes. Don't hire any employees. Only pay 1099 if you want to be able to max out your SEP.
Sounds good. So if anybody on the call or someone, or what resources would you utilize if you are self-employed for health insurance, to sign up for health insurance, because now you're decoupled from your employer?
That's a really good question. I just yesterday, there was a story that I was listening to. I would start as a self-employed person, especially if you're just starting out and you might be in a relatively low tax bracket. I would start with the exchanges. And I just heard the other day, I think maybe I knew this and forgot about it, that with the Affordable Care Act plans that are available on exchanges, there are people called navigators who are available for free to walk you through the different plans and what you qualify for. And it's free, and you at least know what your base level options would be for health insurance if you went that route, and then you could compare it to non-exchange plans. Does anyone else have like self-employed health insurance tips and tricks for people? I just heard that yesterday, and I was like, oh, that would be like, if someone is free, available to walk you through your options on the Affordable Care Act exchanges, it would at least give you one solid good data point that you could compare other things to. So that might be a really good place to start.
The only other, sorry, I'm unmuted. The only other thing, I, as a self-employed person who's been so, at least for the past 10 years, everything I've read is to always choose the cheapest plan that qualifies for HSA. Never, I mean, it depends on your health situation, and if you go to the doctor regularly, or if you have a high price for medication that you know is already built into your life. But whatever money you're not giving to the insurance company, you put in your HSA that you always have as that buffer to pay for those things, but that it almost never pays to have better plans, because it's a rabbit hole to go into, but the HSA qualification really is one of the biggest benefits. In the marketplace, people are like the Vanguard people. They know so much and they're so helpful and answer all of your questions. I've had really good experiences at healthcare.gov.
Awesome. Great, thank you. All right, let's go on to the next one. All right, I like this already. All right, you have $1,000 in your emergency fund, 6 months of expenses saved in cash. You contribute the max to your 401k, and you have a brokerage account. You still have extra money to save. Where do you put the extra money? Oh my gosh, I feel like this is like piggybacking off of what I was just dreaming about. So if you had all of this, it's like this person is like doing it, right? They're checking the boxes. They got everything handled, and there's even more to save. Where would you put the extra money if you were this person? Or if this person is on the call, like, feel free to unmute yourself and give us a little more detail. Let us know what you're in the mood for, right? Or we can just start coming up with ideas for all this extra money.
It's kind of, hi, it's me.
Hey, Yanni.
I'm just graduated from grad school, and thanks to savings and perfect credit, my grad school was paid by credit cards with 0 interest. And so I have no payment I have no debt coming from getting grad school, and I am going to get a job that's going to pay me double of what I currently earn. So this is what I want to know, like, where do I put that extra money right now? Because I am doing everything else already, and I feel that I keep having money on just savings all the time. I don't want to just have savings.
Yeah. Can you tell me a little bit more about the brokerage account you have and why you don't want to, or maybe you do, why you wouldn't want to put the additional savings just in there, in like financial assets, right? If it's a brokerage account, then it's probably in like stocks and bonds and funds, right? Are you shying away from putting more money in the brokerage account? And kind of what are you thinking on that front?
So the brokerage account is with Morgan Stanley, and it's a new person. I never worked with, I started working with him. I just don't know if that's just if I just want to continue working with him, or if I want to continue putting all my money there, or I guess I was just thinking maybe diversifying more, and if it was something outside of that. I guess that was my main reason for asking that question.
Yeah. Okay. Rakshanda asks about real estate.
I was about to say, that's what, we are both on the same page with that and being a private money lender, but it depends on your comfort level with that type of risk. It also depends on how much money you have. But I can tell you that I'm part of a women's Austin networking group, real estate group, and I fund other, I actually have a loan out within my retirement account, and we are netting 10% returns. We're giving each other a 10% return, which is pretty darn good considering that market is usually about an 8, maybe 6% over 10-year span. So I would say that real estate is definitely a way to diversify, but it definitely comes down to your comfort level and if that's something you're even interested in. I'm a huge, I love real estate, but I also, if you don't love real estate, then don't touch real estate, is my, thing. So, but that is something to consider. And there's a ton of people looking for private money lenders.
Yeah, so real estate as an asset class, the way that Sandy is describing it is as an active real estate investor, like putting in the time, right? And being part of this group and having expertise in that area. Is that something that appeals to you at all, Yenny?
Well, real estate is what actually got me where I am right now. And yes, I know that because we sold our house in Texas and moved to a tiny town outside of Texas that has almost no expenses. But no, I do not want to go back to real estate because it's just not something that we liked. We like selling the house, but we don't like any of the other stuff. We were landlords for 2 years, and it's not something we enjoyed.
Yeah. Would you be, so Melissa had a question that she's kind of following up on this idea of the brokerage account. So she says, is it better to have a brokerage account with more than one company or with just one? Right?
Yeah, that was, I think, kind of like my question. Sorry to interrupt, Sarah. That was, I think, what I was coming from. Should I do 2 different companies and just have them kind of look at what one has and the other? That way, if I end up not liking how the one guy works or our personalities don't match, then I can easily just move to someone that I feel more close aligned politically and just general personality-wise.
Oh man, that's a good question. Does anyone else who wants to weigh in on this idea of working with more than one firm or working with more than one advisor? And the pros and cons to that.
Lori, I think that might be hard because each broker that you work with, they're going to want to balance your portfolio, and they won't have any information about what the other person's doing. And that might bother both of them. So I don't know if you'll really get a good insight to how they work. What you could do is, you could just go ahead and get your own funds, don't go through another company, just buy your own Vanguard funds like we were talking about before. and then you could just stash money away there. And if you decide you don't like your current broker, you move to somebody else. If you find somebody you really love and you're tired of doing Vanguard, you could just move all your money over to one place. Yeah, I think doing 2 people is going to be hard, but that's just my opinion.
And I wonder if you started out with 2 people and then figured out who works best and consolidated them eventually, maybe that would be like a different means to the same end, right? Like you're not wild about the new person, but if you're willing to give them a chance and see if a relationship develops, while at the same time starting a new relationship with a new person and seeing if that one works out. Maybe, people do have more than one advisor. That happens all the time, right? And I think that it depends on kind of what you want the end result to be, because it does make it, I think, like Lori said, I think it does. And again, like I'm super biased, right? I'm advisor, remember? So like I'm talking about this, like I want things to be the way that I want them to be and the advice that I'm giving, and I want everything to align with my advice, right? But I understand that people have sometimes come in with a relationship with someone else, and so I have to be a little bit adaptable. Am I willing to do that or not, right? But you do kind of run into the problems that I think Lori is talking about. That doesn't mean that it can't be done, right? If you like both people, or if you task each person with a different mandate maybe, or if you have 2 advisors for some finite period of time while you're waiting to see which one works best for you, right? Like while you build a relationship, because I certainly think that relationships are the most important thing here. And if you're not getting a really good vibe from your new person, that is a problem, and it's a tough one to overcome, right? So unless you're willing to like go into a different asset class, or unless you're willing to manage it on your own, like either at Vanguard or do something in real estate or something like that, then I think finding the person is a good road to go down to see where you can get that comfort level. Caitlin, were you going to say something?
I was just going to say, I think it depends on how crazy you want to make yourself. Like, I feel like what I've been learning over this whole time is there's a certain extent that like our desire to control, we want more money, we feel like there's a decision to be made every hour about it, and that can really make you crazy, and that sometimes it feels like getting all of this advice is really helpful, talk to a million different people. But at a certain point, you actually, unless that's your full-time job, you can't sift through all of that information and redo your perspective for me, it's exhausting, and it makes me much more stressed. So if I found somebody that I liked, I wouldn't just throw my lot in with them blindly, but I'd be informed and want to have conversations about what it was. But if I am second guessing what one person is doing and the other person each time and playing them off of each other, I will go insane. So the cost of maybe gaming that system would be a deterioration in mental health for me, and worrying about my money disproportionately to, rather than just accepting, like, I'm choosing this path. No one has a crystal ball. I'm hoping for the best here. And I know from my education that this is not a crazy strategy. This makes sense. And just, as they keep saying, set it and forget it. For me, every time I have to make one of these decisions, it makes me crazy. And the idea of like continuing that game again and again, I might feel like I had more control, but in the end, I think I would lose it all, because in the end, I'd be like, oh, fuck it. I don't care. Just something. Anyway, it's personal.
I think it also depends on what your interaction is with your fiduciary, or who your custodian, right? Because like I inherited an IRA, and I inherited my dad's person. And for many years, like he would call me like once or twice a year and be like, hey, Sandy, your accounts are up by this much. I think I want to do X, Y, and Z. And for the most part, I was like, dude, do whatever you want. Like, I'm not even there yet. Right. I'm not even conscious. Like I'm just, you know, I'm like a big, you know, so I didn't interact with him a lot. And even this day, and I know more, the only thing I ask him is, you know, hey, my RMD is coming up. Do we have enough cash? Please don't wait till the last minute where you have to sell an asset. That's, you know, I don't want to lose an asset that we don't really want to get rid of because we have to liquidate, you know, to pay an RMD. So I think it depends on what you want from the advisor or whatever this is, because it could be a set it and forget it, right? It's possible that you have multiple, you know, firms, depending on what your goal is with that and how often you intend to interact with these, you know, with them and what's in. Because I have an advisor, and then I also do my own Vanguard thing. So I'm split between 2 brokerage right now, and it's not a big deal because I literally don't check my accounts every day, like, or even every month. Occasionally, like every 6 months or so, I'll go back and kind of look and see what's going on. But I usually, where I'm at right now is set it and forget it. So that's pretty much where I'm at. There was a few people that was asking about the real estate stuff that I had mentioned. So I joined an Austin Women's Flipping group that is a paid program, and there are people that have graduated from the program or basically you only get it for a year. And so we formed this little network. In fact, I'm have to leave soon because I'm doing happy hour with the girls. And so, so it is a local, so I have the paid program, but then we just kind of formed our own little group. As far as the private money lending and things like that, that is a whole different ball game, but it is where you can, if somebody has money, like for instance, let's say that I found a house I wanted to flip in Austin and I needed gap funding, right? So I could go get lending or what have you, but I just needed cash to close. I could go to somebody and say, will you lend me $25,000? We can secure it against the property and I will give you a 10% return. And usually flips are, ideally you want to get in and out of a flip within 3 to 4 months. 6 months, pretty long flip, but you can do that. So that's like the really, really short synopsis of that as far as the little group. Like anybody who's interested in real estate, I mean, if you want to ping me, I can, we have very informal meetups. Like literally we were on Messenger and people were like, hey, when are we going to get together? And I'm like, let's do it Saturday. And there's not a lot of us getting together, but there's a few. So it's a kind of a random thing with that.
Cool. Did you, is there a way for people to reach out to you, Sandy? Like if they have, did you?
Yeah, I can put I'll put my email in the chat.
Thank you. Thank you. Thank you. Thank you. Awesome.
Yep.
See, I love these like little, just like discussions that just pop up, right? It's so interesting. Cool. Okay, great. All right, I'm going to keep going on the Q&A, and then Sandy just dropped her email into the chat box. So, and Gwen, I think we're going to, if you don't save her email and want it, just reach out to us, and we'll make sure to connect whoever needs to be connected to whoever through the group. All right, cool. All right, next slide, rising costs. Okay, this is a good one. How can I best plan for rising healthcare costs, especially if I'm a contract worker, independent business owner, or planning to retire before Medicare? Great one. So this is specific to rising healthcare costs and or filling in. It kind of piggybacks, I think, a little bit off what you were talking about before, like finding the plan that fills in the gap if you are self-employed or independent before Medicare. But is there anyone who has kind of started or gone through the process of navigating rising healthcare costs or planning for it? One of the things that I'll throw out while people are thinking about the question first of all, is the person who asked the question here? And can you give us a little bit more detail? Maybe specifically about like timing?
It was my question.
Awesome.
It was my question. Since I am self-employed, I already pay a high premium. I pay about $600 a month, and I'm 50. and I see 20 years of that. and you know, besides making it a line item, I don't really see what the solution is. You know, making a sinking fund for healthcare costs, you know, staying healthy. You know, I really don't know. I have a HSA, but yeah, I don't know what the solution is to those costs. And I always wonder, like, people that are doing the FIRE movement or the FI movement, and they want to retire at 50 or they want to retire at 55, you know, what are those people doing? I thought maybe they'd have a solution, and I don't really know what it is. So, yeah.
Yeah. It's a really good question. So the way that I think about this, right? Again, also self-employed. First of all, is like setting up like the basic framework to be flexible in this area over long periods of time. So first and foremost, health insurance, right? Sounds like you have that covered, right? It's a sizable amount, and just the $600 just gets you the health insurance, right? Like, it doesn't cover things that aren't covered, you know, and so, you know, there's additional costs above and beyond that. One of, like, this isn't super difficult for me, and it might not be too difficult for you either, but like for investing for higher costs over time, you're only 50, right? And you're planning for a long period of time. Whenever you have to worry about inflation in any area, you have to figure out how to invest in things that keep pace with inflation, right? So the sinking fund is interesting, right? Except that if healthcare costs are going up at 5 to 7% per year, and you know, you're setting aside $1,000 a month or something like that, you're very quickly losing pace unless you're investing that money in something that you're putting at risk in order to get higher rates of return over time, right? With healthcare and education as a self-employed person, though, that has been, and I don't know if this is the perfect strategy, right? But that has been my strategy. It's kind of like a barbell approach. It's, okay, I'm going to save and invest aggressively in this account over here for unexpected costs. I don't know if that's going to perfectly match up with when these costs come online, but I'm doing the best I can over here. And then the barbell over here is always having lines of credit and the ability to borrow against stable assets like my house, right? Which, like, in Austin is now like, okay, everybody look at your Austin house, figure out how you can borrow against the equity if you need to, right? Now's the time. So I know that's not, I find that, like, from a planning perspective, I mean, what's so challenging about planning for rising healthcare costs is that those costs are lumpy and not correlated with anything, right? Or, you know, if you stay healthy, maybe you never end up needing to fund a bunch of out-of-pocket costs. But if something does happen, it could be catastrophic, right? So, like, trying to mitigate the risks of a catastrophic loss while having different and flexible sources of funding if you end up somewhere in the middle. Between catastrophic and just, like, really expensive. Does that make sense? Am I on the right track here with the way you're thinking about things? Or are there issues that, like, other issues on your mind?
I think that's 100%. I mean, I think it's a bigger picture item, and I just, you know, I thought anybody might have any input, but I think it's just something you have to plan for. Yeah. Yeah,
I know. It's, I know it's so hard to plan for, right? But it's absolutely, like, almost always the first thing on people's mind, right? It's like, okay, like, I know these things are expensive, especially if you watch someone go through needing expensive care, right? Like, oh my gosh, like, how am I going to pay for this if and when that happens to me? And if you have a long enough, well, I mean, you hope you have a long enough time horizon, right? Where you're 50, and, you know, if something like home care in your later years is what you're planning for. I mean, I think one of the things I also think about is, like, it's really hard. You could do it with insurance products, right? Like planning for that, the catastrophic long-term expensive care, right? Which is really like, okay, that's a tough issue, right? Like, you know, if you were incapacitated but didn't die, you know, so like life insurance didn't pay out, right? Like, okay, how do you fund something like that? I mean, I think that, again, like the way I invest and the way that I think about this and the way I think about it as like a woman's issue is the answer, one of the answers is to have more money, right? And so the way you get more money is by saving money and investing it aggressively and hoping that you know, that's the path that you're on. And then if there's a gap in that coverage, something catastrophic, can you fill it in with insurance, right? Short-term disability, long-term disability, for how long? Then, you know, knowing what comes online at 65 with Medicare, right? And we have Michelle in our group who's going to do another Medicare talk later this year, right? Like, okay, what exactly comes online at age 65 that is covered by Medicare? I mean, I think someone just proposed a bill that would extend Medicare to people 50 and over. I mean, you'd have to pay for it before 65, but that it's like a good plan and it would be relatively affordable. But it's probably like the toughest planning issue out there, I would say. Does anybody else have any input or any ways they've seen other people navigate this successfully or really unsuccessfully? Either thing is good to hear about.
One of the things as a freelancer I've considered, and I know a few people have done it, is like at a certain point in life decided to take a part-time job with a place that provided benefits for part-time people. And sometimes government agencies do that. And so it might not make sense for me at 45, but maybe at 50 it would, because my likelihood of having a health issue, and sort of just playing it that way, that if you have, I mean, I think rising healthcare costs are going to affect everyone across the board if they have employer-based health insurance or not, but that could be a way to mitigate too, to do research about what is the fewest amount of hours you would have to work for a company or an institution and get their benefits, and at what age might you be more willing to consider that, because independently your rates would go down. And also, to speak to Sarah's point, disability insurance versus life insurance. Like for me, if I died, my daughter would be okay because of what I have. But if I survive and I can't work, that's a much harder situation for all of us to tackle.
Really, really good question. And I'm sorry, Ruth, I don't know if we, hopefully, again, it's just like, I don't know. I think most of the time in this group, we end up talking about like, okay, how to think about things, right? And just me hearing how you and Caitlin think about it, maybe you hearing how I think about it. It's just like, okay, like, how do we think about these things, knowing that in almost all cases, there's no really perfect solution when it comes to this. So in June, maybe this is a follow-up question to kind of the healthcare costs. June asks, should you invest your HSA? I have opportunity to invest the money in my HSA. That stands for health savings account, by the way. I do have medical expenses, but I've been paying out of pocket, as they say you can make claim even in later years. I'm considering the investment would remediate the higher cost of medical as I age as a strategy, but didn't pull the plug. I think with HSAs, right? So the idea is like, okay, you or maybe an employer put money into an HSA, and it's kind of like a checking account, right? Like you pay bills out of that account. But sometimes you can have an investment option. It's like in a brokerage account that's attached to your HSA. So you can sweep cash out of the HSA into the brokerage account that is attached to the HSA. So that if you don't need the cash, you can set it aside in the investment portion and invest it for higher growth where it's not sitting in cash. June, I tend to think of this issue that you asked about in the opposite way, where if you need the cash now, pay it out of the HSA because that's what it's for. But if you have extra money and there's an amount in the HSA that you don't need, for 10 or 15 years to sweep that over to the investment side and invest it in something that could grow over 5 to 10 to 20 years. Again, in order to keep pace with the rising costs of healthcare that far into the future. I mean, really like the main asset classes that could possibly do that are stocks and maybe real estate in the form of REITs and something like that. So I think I think of it in the opposite way that it seems like you put it in the chat box, that like extra money can and should be invested if you have like a relative certainty that you're not going to need it to pay medical expenses right this very second. And that's how I think about my HSA. Does anyone else want to weigh in on that? And maybe we can loop back around to that if there's more questions kind of at the end here. Cool. All right. This is our last slide. Ooh, if I can get to it. And I think this is where it starts getting real. We start talking about some more like fun speculative stuff. We have 13 minutes left. So maybe we can talk about this really quickly, and I'm happy to stick around if anyone wants to stay after with extra questions. I'm happy to stay a little bit later. So here, like for kind of some more speculative questions, which I love, are cryptocurrencies or alternative currencies worthy investment considerations? Any thoughts on Forex, right? So foreign exchange, and any ideas on how to invest in renewable energy? I just managed to close all my boxes. Okay, so I would say on the investment in renewable energy, if I am able to do that, I'm gonna punt that to next month because that will be part of Casey's environmental, social, governance, ESG investing topic that we're doing next month. So, though I will throw out that there are a couple renewable energy companies. There's one called, the ticker symbol is NEP. And now I'm blanking on what the name of the company is, but the ticker symbol is NEP, and I think it focuses on renewable energy creation. So that's not a recommendation. It's just like a place that you can look. But I would say for, again, investing in green energy, things like that, come back next month. And I think there will be more specific action items on that one. On cryptocurrencies, alternative currencies, Forex, kind of some of these new asset classes that are popping up. I like the term worthy investment considerations. So if whoever answered or whoever asked this question is on the call, I'd love to hear more about kind of what you're thinking with these investment options. And if you're not on the call, I would say I'm a believer in what the industry is starting to call digital assets as an asset class, but it is emerging. It's an emerging asset class. And one of the risks with emerging asset classes is that you don't know who the winners are going to be, right? That's what makes it so fun. Right, so I think cryptocurrencies, tokens, the tokenization of things like blockchain, kind of all of these concepts, I think that as a concept, it's going to persist over time. And so as an investor, I think it's worth it for every single investor to get up to speed and form an opinion on whether or not you believe in digital assets as well. That doesn't mean everyone should invest in them. I think it believes that everyone owes it to themselves to either get up to speed on their own, loop in their advisor, find out what their advisor thinks, to form your own opinion as to whether you're in or out. Because I think it's going to stick around. The finding the investments part is trickier, right? Because things are moving and changing so fast that it's incredibly risky, right? Like if you even talk about Bitcoin, which is like the name brand cryptocurrency or digital asset that everybody knows about, it's only been around since 2009. I think I saw the other day that since 2009, which is not that long ago, Bitcoin has lost 80% of its value like 8 or 9 times since then. right? So your range of outcomes, if we're talking about the stock market, your range of outcomes is probably most of the time going to be between, up 30% and down 30%. These new asset classes, your expected outcomes is something like, I don't know, up 1,000% or down 100%, down 99%, right? So there's just like there's a wider range of outcomes. And that typically means that if you go into that area, you might want to allocate a smaller amount, right? So that if you choose the wrong thing and it goes to zero, that you haven't blown up your entire financial plan. So that's kind of my short answer to these things. So I think that I think that there are worthy investment considerations, and that every investor at some point is going to have to make the decision whether that profile works for them or not, and in what percentage. And that if you say, no, I'm not going to invest in this asset class, that you do it after doing some amount of research, right? Because it is because it's so new and difficult for so many people to get up to speed on what it is, it's very easy to just knee-jerk reaction, say no, right? Or say yes, right? Knee-jerk reaction to say yes because, I don't know, it seems like, FOMO is kicking in and you don't want to miss out on something, but you don't even really know what you're investing in. So that's what makes it so dangerous. But I think it's something to keep an eye on. We have, I've done several webinars with a company called Investera, and they do really good cryptocurrency webinars. They are absolutely pro Bitcoin, pro digital assets, and that's what their webinars are framed at, but they do a really good job on the education side too. So we sometimes have their events posted on the Facebook page. So definitely that's something, where you can get more information there. Gwen asked if there's something like an index fund for crypto. It's a great question. Nicole said, I think there's one in the works, maybe with Fidelity. So I think there are 8 or 9 companies that have applied to the SEC, the Securities and Exchange Commission, for permission to have a Bitcoin ETF, but it hasn't been approved by the SEC yet. There are at least 2 listed in Canada that some brokers will give you access to, but some won't. And then there are a handful of they're organized as trusts, available, with the Grayscale Bitcoin Trust being the largest one that would be available for investors in the US. So again, it's so new that there's not even an ETF for it in the US yet, right? But it's probably on the way. So it's something to keep an eye on. Investera is Jill, was that your question? It's Investera is the company, yeah, that Gwen and I just put in there, where they're doing these seminars on crypto. So I love that. Really good questions. And I think that we're going to end, for a moment on one of my favorite Warren Buffett quotes. Someone is sitting in the shade today because someone planted a tree a long time ago. We're just trying to start this process and plant these seeds so that they can grow in the future. And then we can all come back in the next 10 years and look back to 2021 and be like, oh, remember all those awesome things we did in 2021, those things we invested in, and now we have enough to take care of ourselves and our families and the people around us. So that's, again, what the whole purpose of this group is for. Again, it's 4:24, so we have 6 minutes to answer follow-up questions that have come in the chat box while we've been talking. So Gwen, do you have 1 or 2 that you would like to throw out for the group?
Yeah, there was actually a question that was submitted through the meetup that I didn't have the chance to put in the slides. But the question was, are other group members generating numeric valuations for the companies that they're investing in? And I thought that might be a good one to throw out at the end here.
Is someone doing the fundamental research to put a price target on the companies they're investing in?
Yeah, and if they are, what does that look like?
I don't know. Are any of you guys doing that? I don't know if anything that specific has come up in our in our meeting, so I actually don't know the answer to that. I think mostly people here in this group are investing through ETFs and mutual funds. And I don't know if those of you who are in individual funds go, like how deep your analysis goes. So I don't know. Good question. If anyone has kind of an analysis they would like to present to the group and show people how they do things, that would be awesome. I think that I would say that if you are looking to do that, like set price targets and do fundamental analysis, you might want, I think you would need to start paying for more in-depth educational resources, things like analyzing financial statements. You know, here, I think in the group we've talked a little bit about PE ratios and how to use those. I use PE ratios and PEG ratios a lot when I'm doing, when trying to figure out investments. So that could be really helpful. But certainly, like once you're building spreadsheets and doing projections, like you're getting into some really cool but in-depth analysis of individual companies. Great question.
Okay, there were quite a few questions, and I just wanted to let everybody know, if you aren't on our Facebook group yet, and we didn't get to your question today, I would say that posting, making a post in the Facebook group and just getting everybody to weigh in. There's, you know, there were, I think, about 20 of us on the call today, but sticking a question in the Facebook group is going to get a lot more eyes on it too. So that might be a great place to plant your question if we weren't able to get to it today. I think that June's question here about how do you invest or contribute a large amount of money might also be a good one for us to end on.
Yeah. Oh, June, that's a great question. I love that question. Yeah. So that's like that's a really great question, right? Because it's, you kind of have to decide between lump sum investing, right? When you just like have some money and you just plop it all in at once, right? Or do you chop it up into little pieces and do dollar cost averaging, which is something that Sandy mentioned before, while she was on the call. And so there was a white paper that Vanguard did a couple of years ago where they looked at the difference between these two things. And I think that like the gist of the story is like, okay, maybe like 60-ish% of the time, it's better to lump sum invest, right? So you just have some cash, you just dump it all into your investments and let it start going, right? Because most of the time, like as in like, I don't know, 70% of the time, the stock market is up year over year on a price basis, right? So the stock market goes up every year 70% of the time. But the 30% of the time that it doesn't go up, it can go down by a lot, right? So you can take advantage of that compounding by putting everything in at once, right? It's like taking advantage of compounding and the trends of the stock market over time. But behaviorally, that's a tough pill to swallow for a lot of investors, right? Like, so if you put your $12,000, right, or your $100,000, your $112,000, right? What would you do if you lump sum invested that on Monday and then the stock market fell by 15%, right? A lot of people behaviorally would be like, okay, I am not up for that at all. Like, I want to avoid that. That would really scare me. So you can do something called dollar cost averaging, right? Where you take your $112,000 and it would be kind of easy to divide it up into 12 and invest $10,000 per month for 12 months. Where you're just like, okay, by this time in 2022, I'm gonna be fully invested, right? And $10,000 a month, just like clockwork, without thinking about it and without guessing at that moment in time whether you should go in or not. You take that off the table and you just say, okay, on the 25th of each month, I invest $10,000. Some months the stock market will have fallen and you'll be buying low, right? Some months the stock market will have gone up and you'll buy high, But over time, you'll do something called dollar cost averaging. And that's a really effective way for people to invest. And it doesn't have to be 12 months. It can be 3 months. It can be 24 months. It can be any number of months that you want. But the idea is that, okay, this lump sum, its job is to be invested. We want it to grow over time. The only way it's going to grow is if it gets invested. So what works for you to get it into the market? And that probably depends a lot on like your temperament and your risk tolerance. So I don't know, like, does one of those appeal more to you than the other one?
Yeah, considering, hi, I'm June. Considering
June.
that they keep on speculating, we're all-time high every few weeks, and it seems like maybe it'll bust soon, and I'm just afraid of considering putting all that amount of money and losing. So
yeah,
I've been hesitating so long that, you know, because this has been a few years, and when I found out it was in cash, I was like, well, what do? I don't know what to do. So I just, like, some people have mentioned the word of paralysis, and
yeah,
you know, stuff there.
Oh, that's so hard. But yes, it's like, yes, that happens all the time. And so, oh, Gwen, I wish we had that chart, right? So
I know, I'm actually looking for it right now.
So we have this chart, this like investing at all-time highs chart, because what you're describing is really common. And it's this idea that if the market's at all-time highs, the only direction it can go is down, right? Which is actually not true. Like the stock market spends, I think, well, like if Gwen's able to pull up the chart, it's like the stock market spends more than 50% of the time at or within 5% of its all-time highs, right? Which is actually like, I don't know if I would estimate that if someone asked me and if I didn't know this chart, right? That maybe Gwen will find. If not, we'll send it out to the group as part of the follow-up, right? But it's this idea, like the stock market trends upward, right? Because the companies in our economy get more profitable over time, right? And so the stock market trends upward. It spends most of the time at or near all-time highs because it's always moving up, has always moved up. It doesn't mean it will always move up in the future. So like maybe for you, if you've already come this far and you don't want to sit out for another 3 years, you could maybe kind of combine these two things to like turn it to your advantage. This is what I would do if I were you. I would do the dollar cost averaging, but if the market fell, which is what you're currently kind of worried about, but you could turn that to your advantage by saying, like, if the market fell by 10%, you would invest twice as much as you were planning on it, right? You're accelerating your investment into the decline, because while you're worried about it right now, if you're buying, you should be excited about lower prices, right? But that way, if the market doesn't crash, you will be invested by this time next year. And this decision will have moved off your plate, right? Oh, great, thanks, Glenn. So this is a chart that shows, okay, how often is the stock market at or within all-time highs? Okay, so since this has been updated with COVID, right? Here, 47% of the time, the stock market is at or near all-time highs, right? So that's where the green is. If we add another, what is that, 50, 60, 65% of the time, the stock market is at or within 10% of its all-time highs.
Mm-hmm.
So that means, like, to me, the way I view that, I'm like, okay, those dips are valuable, and they can happen for a long time, right? Like here, they can persist for a long time. That's certainly the case. But if we're in a long-term secular uptrend, which maybe we are, maybe we aren't, if we are in a long-term uptrend, those dips become really valuable buying opportunities that don't last very long, right? Like March 2020. Your buying opportunity lasted like a month, maybe, and most people were too freaked out to invest, right? We had meetings, we were talking through it. Most people were just like sidestepping it, right? And like, you know, not trying to participate in it, but now it looks like a buying opportunity. So like, it's part of like figuring out for yourself, like, how do you break the analysis paralysis? And sometimes it's just having a super simple plan, and no plan has to be perfect. So it's like writing down your plan and then implementing the plan. And then, you know, at some point, whenever you're in the stock market, you have to, you know, we talk about this a lot. Whenever you're in the stock market, you have to take what the market gives you, right? You can't control it and you can't predict it. So then once you're in, you're just kind of in for the long run. So is that helpful at all? Like, I feel for you, because that is like a really common occurrence, right? Where it's like, I've been meaning to invest this for a long time and I just haven't. And now it's 5 years later. But like, you know, you can start now and you'll be in a different place a year from now. Hopefully like a better place where you're invested and kind of comfortable with whatever strategy you've come up with.
Yeah, you gave me a great like confidence in that, because you don't want to lose out the opportunity of the growth, but you don't want to lose out on the opportunity of a great buying time that is, it sounds like it's soon to happen. So your strategy helped me satisfy both. And yeah, last year I wanted to get into the March, and like you said, I was missing the plan. Like, I knew that that's what I want to do, but I didn't know the steps to do it. So I have tough, but now I'm in. Yeah, you gave me some great ideas. Thank you.
Oh, that's so awesome. I can't wait to check back in a year from now and see if you did it. Which you will, right? You will. You just have to, and I find like writing it down and putting it on a sticky note. I have all these like sticky notes that I had written to myself during March of last year that I now like keep for posterity, right? I'm like, oh, that was very wise. Like, all right, you know, but it's like, it's mostly because like when the market is falling, it's because people are scared, right? It's because something scary is happening. And so if you don't have it written down, you can talk yourself out of it very easily, right? Just like, oh, I'll just wait till things get better. And then things get better, and then you're back at all-time highs, and now you've just talked yourself out of both things, right? So the writing down of the plan is so helpful. It sounds so simple, but it's so helpful. Like, I'm gonna invest this money. So good luck to you doing that.
I have to know, Sarah, is that a psychological trick to tell people like June and me so that we'll just get into the market? Or does the math bear it out? Like, if that 100,000 started today and come what may, you looked at that amount in 10 years versus if she does 10,000 a month in that same amount, would there be a significant difference? I get psychologically, it's really great, but math-wise, is there a difference?
Yeah, that's what Fidelity, or that's what Vanguard said, is that it's almost always better. Go ahead, Gwen.
There's a Reddit thread that I read a long time ago. I read it on Reddit, and this guy who I guess just like has, this is either like his thing, like his niche, is he likes to play around with like spreadsheets of historical data from the S&P 500 like over time. He ran 3 scenarios, one where this person was just the most unlucky person ever and only bought in at like points where we were like at all-time highs. And I can't remember what the time horizon was, but it was the same for all 3 people. So this person was super unlucky. Another person was extremely lucky, bought every single dip. And then the third person just did the dollar cost averaging and like, you know, chugged away. So, and he ran the numbers, and I mean, they all grew their money. But the person that did the dollar cost averaging, like far and away, was they grew their money just the most. And even the person that was the luckiest bought the dips did not grow their money as much as that person did. And so even if you happen to have that really good luck, which, you know, this person is looking at historical data, so we can't even predict.
Right.
But if you happen to have that really good luck, it might even just be better to stick to that plan and do it regularly.
That's so good to know.
Yeah, I have to find that thread, because it's like that thread plus seeing that chart that we just showed kind of changes your perspective. Because yeah, if you hear like all-time highs, you're like, okay, well, it's got to drop at some point, and it's probably going to be soon. But then if you're like looking at the data, I feel like it gives you that confidence that June was talking about. You're like, okay, you know, this is the plan, and sticking to it is going to really pay off in the future.
I mean, and I think that you're kind of lucky, June, because like really the only thing you have to do over whatever your investing time horizon is do better than 0, right? Because if you're at 0% now, then once you're invested, the idea is, okay, like hopefully whatever you are invested in grows by more than zero, right? Like that's like, if you keep going like with it in cash, then okay, you're locking in 0% for a long time.